Wow, what a Friday! Seriously, this was a day packed with some absolutely whiplash-inducing headlines. We had a huge inflation report in the US that caught pretty much everyone off guard, a really deep economic divide opening up over in Europe, and then a geopolitical bombshell dropped on social media. So let's get into it and unpack what on earth happened on this wild day in the markets.
So here's the game plan. We're going to kick things off with that surprise US inflation report. Then we'll hop over to Europe to look at its strange two-speed economy. From there, we'll unpack the sudden trade turmoil between the US and Canada. And finally, we'll connect all the dots to the actual market moves and see what's on the calendar for next week.
You know, the entire market was basically holding its breath for one key piece of data today, the US Consumer Price Index, or CPI. This is the number. It really sets the tone for everything, from where interest rates are headed to global risk sentiment in general.
So the million-dollar question on every single trader's mind was this: are we finally seeing these relentless price pressures ease up? And look, this isn't just some academic question, right? The answer directly tells us what the Federal Reserve might do next. A hot number would have meant more aggressive rate hikes were back on the table, but a cool number, well, that would give them some much-needed breathing room to pause.
And boy, did we get a surprise. The results were a definitive miss to the downside. I mean, look at this. Every single key metric came in below what analysts were forecasting. Headline inflation was up just 0.3% for the month. But the really crucial number here, the one the Fed watches like a hawk, is core CPI. It came in at just 0.2%. By stripping out the volatile food and energy prices, it gives a much better signal of where inflation is really trending.
So what does this actually mean for policy? Well, the most important takeaway is that the market immediately saw this as a green light for the Fed to ease off the brakes. The pressure to push through another big, aggressive rate hike just kind of evaporated. And that changes the entire math for asset prices.
And you could see the impact hit the currency markets almost instantly. Take a look at the US dollar versus the Japanese yen. Before the CPI data came out, the dollar was trading pretty strong. The moment that cooler inflation number hit the wires, the dollar just dropped sharply. This is a classic risk-on reaction rate. Expectations of lower US interest rates just make holding dollars a little less attractive. Okay, now let's shift gears and hop across the pond to Europe, where honestly the story is a whole lot more complicated. While the US got a pretty clear signal on inflation, the economic picture coming out of the Eurozone revealed this starkly divided landscape.
The Purchasing Managers' Index data basically painted a tale of two completely different economies. On one side, you have Germany, the bloc's biggest economy, showing this surprising surge of activity. Its composite PMI jumped to 53.8, which is its strongest reading since May of 2023, and it's all being driven by a booming services sector. But then, on the flip side, you have France, the second largest economy, which just keeps shrinking. Its PMI fell to 46.8. Think about that. That is the 14th month in a row of contraction.
This quote from an HSBC economist really just hits the nail on the head. Germany is trying to pull the Eurozone's average up, but France is acting as the significant drag. And this divergence, it creates a massive headache for the European Central Bank. I mean, how do you set one single monetary policy for a region where one economic engine is revving up while the other is stalling out? It is a major, major challenge.
And just when you thought diverging economies were enough to digest for one day, bam, the market got hit with a major political shockwave. Seemingly out of nowhere, trade relations between the United States and Canada, its second largest trading partner, just completely imploded.
This is the message that flashed across screens, coming directly from President Trump's social media account. There was no warning, no diplomatic lead-up, nothing. Just an abrupt, total termination of all trade talks. The severity and just the sheer suddenness of it all sent shockwaves through both the political and the financial worlds. So how on earth did we get here? Well, the trigger, believe it or not, was an ad campaign funded by the government of Ontario, Canada. This ad used a clip from a 1987 speech by former President Ronald Reagan, a Republican icon, to argue against protectionism and tariffs. The Reagan Foundation then publicly objected, and within just a few hours, President Trump pulled the plug on everything.
But, you know, when you dig a little deeper, the reaction was about more than just an ad. Reports are indicating that President Trump saw this as a direct political attack, and one that was timed specifically to influence an upcoming Supreme Court hearing on the constitutionality of his tariffs. This whole chaotic situation really stands in stark contrast to the more structured, ongoing trade talks with China, and it just highlights how personal and unpredictable this dispute became.
Okay, so let's tie all these different threads together. We've got cooling inflation, a divided Europe, and a trade war suddenly erupting with a key ally. How did the markets actually process all of this? Let's take a look at the major movers.
The dominant theme, at least for US stocks, was pure optimism. That softer CPI data was absolutely the main driver, and it fueled a classic risk-on mood. The idea that the Federal Reserve might back off on rate hikes was enough to overshadow all the geopolitical noise, and it sent S&P 500 and NASDAQ futures pointing decidedly higher.
And it wasn't just the macro picture either. We also saw some really strong performance from individual companies that provided a major boost. The British bank NatWest saw its shares hit a 15-year high after completely smashing its earnings expectations. In the tech world, Intel's upbeat forecast sent its stock soaring nearly 8%, and that had a nice knock-on effect, lifting its European suppliers too. And over in the defense sector, Sweden's Saab jumped over 6% on strong results and a massive backlog of orders.
Whew, that brings us to the end of a very, very eventful week. But the volatility is likely far from over. So let's take a quick look at what's waiting for us on the horizon. Looking ahead, if we take a peek at the economic calendar from investing.com, it shows several high-stakes events that could easily set the market's tone as we head towards the end of the month. There are really three big things that stand out. First up, the U.S. Federal Reserve meeting. After today's soft CPI number, all eyes will be on the Fed to see if there's any change in their tone or their forward guidance. Second, we've got a huge slate of earnings coming from major tech companies, which will really test whether the sector's incredible momentum can keep going. And finally, those high-level US-China trade meetings will determine if we see a breakthrough or an escalation in that crucial relationship.
And all of this leaves us with one final crucial question. We've got central banks trying to navigate completely different economic paths in the US and Europe. We have unpredictable political actors who can derail global trade with a single social media post. And yet equity markets seem focused only on the good news. In a world this uncertain, could it be that market complacency is the biggest risk that we're not pricing in? That's definitely something we'll be watching. Thanks for watching. Don't forget to like and subscribe.